Okay, let's talk about financial security. For so many people, it feels like this big, complicated game, and nobody ever handed you the rule book. So that really begs the question, right? How can you possibly win a game if you don't even know the rules? Our whole goal here is to pull back the curtain on some of those fundamentals so you can finally start playing to win. So where do we even begin? Well, first we've got to get real about the situation on the ground. The financial squeeze that's a daily reality for millions of families. Before we can talk about solutions, we have to get a handle on the size of the problem. So just how real and how serious are these challenges people are facing? Let's take a look at the data. Wow. Let's start with this number. Over $100,000. According to our sources, that's the average consumer debt for an American. And we're not just talking about one thing here. This is the whole enchilada. Mortgages, car loans, credit cards, it all adds up to this immense financial weight. And it's not just about the big long-term debt. It's about right now, today. A staggering 60% of Americans are living paycheck to paycheck. Think about what that means. Absolutely no wiggle room, no safety net for when life, inevitably happens. And that brings us to the final piece of this tough puzzle: protection. Nearly half of all Americans, 48%, have no life insurance coverage at all. That's a massive gamble, leaving families completely exposed and financially vulnerable if the worst should happen. Okay, I know. Seeing those numbers can feel pretty bleak, but here's where things start to turn around. The good news is financial success isn't some secret code only for the super rich. It's actually about understanding a few really simple but incredibly powerful rules. Let me share one of the coolest secrets in finance. It's called the Rule of 72. It sounds complicated, but it's dead simple. You just take the number 72, divide it by whatever interest rate you're getting, and boom. That's roughly how many years it'll take for your money to double. It's like a back-of-the-napkin superpower for understanding growth. Now let's really see this in action because it's pretty dramatic. Let's say you invest 10 grand. At a 3% return, it doubles to 20 grand in 24 years. Not bad. But what if you could get a 12% return? Now it doubles in just 6 years. And here's where it gets wild. Fast forward 48 years. That same $10,000 is either $40,000 or it's over $2.5 million. The only real difference? The rate of return and time. So you see how powerful compounding is, right? It's like financial magic. But every magic trick has a flip side. And in this case, it's a really big one. The incredibly high cost of waiting. And just how high is that cost? Brace yourself, because these numbers are stunning. If you start saving just $200 a month at age 25, you could have almost $1 million by 65. But if you wait just 5 years to start, that delay costs you over $350,000. Wait 15 years, the potential loss is over $700,000. It's just gone. The lesson here is so clear. The most powerful thing you can do is start now. Okay, so we've talked about growing your money, but what about protecting it? And that brings us to life insurance, which, let's be honest, can feel pretty complicated. But our sources frame it as a totally fundamental tool for handling financial risk. When you strip it all the way, what even is insurance? It's actually a pretty simple and kind of brilliant idea. You're just transferring risk. Instead of you holding on to the scary possibility of a huge financial loss all by yourself, you hand it over to an insurance company. They then spread that risk out across a large group of people. It's like a financial safety net woven by many. Now, when we talk about life insurance, the sources point to two main paths you can go down. On one side, you've got term insurance. Just think of it as pure, no-frills protection for a set amount of time. It's straightforward. On the other side, you have cash value policies, like whole or universal life, which try to do two things at once: combine that death benefit with a savings or investment component. All right, theory is one thing, but how do these two different approaches actually stack up in the real world? Let's dive into a case study that really illustrates this popular philosophy of buy term and invest the difference. This is such a powerful comparison. Let's meet our hypothetical couple, John and Mary. They've got a budget of $251 a month. With an indexed universal life policy, they get their death benefit and potentially accumulate about $127,000 by age 65. But what if they buy a less expensive term policy for $82 and invest the remaining $169? The potential outcome is just dramatically different. Over $311,000. That's a potential difference of over $184,000 from the exact same monthly budget. So you have to ask, why? What's going on here? Well, industry observers keep pointing to one major factor: fees. And you don't have to take my word for it. Here's what one source, Investopedia, has to say. The high cost of premiums and fees makes IULs expensive and considerably less affordable than term life. This really highlights that cost barrier as a significant thing to consider. And another observer, NerdWallet, adds this really important point. Those fees can increase over time and may eat into the payments you make or the value of your cash account. In other words, they can potentially erode the very growth you are hoping to achieve in the first place. So with all this information, how do you apply it to your life? This final section is about turning these concepts into a personal blueprint by figuring out your specific number. That number is your financial independence number, or FIN. It's such a powerful concept. It's a specific amount of money you need to have saved so you can live off the investment growth without ever touching the principal. It's the number that truly defines financial freedom. And you can actually estimate this number for yourself by following these steps: defining your income, adjusting for inflation, and calculating the capital needed. You can work backwards to a monthly savings goal. This whole process turns a huge abstract objective into a concrete, manageable plan. You know, all of this leads to a pretty crucial question. In an age of information overload, with financial advice coming from everywhere, how is it that such fundamental knowledge, like the Rule of 72 or the true cost of waiting, isn't reaching the people who need it most? And this brings us to the final takeaway. What role can focused financial education play in closing this knowledge gap for your family? The answer to that question could truly change your future. Thanks for joining us.